This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Giving back a little bit here today, August 2023, 2 chapters from my classic best-selling book, Trend Following. First, the preface, and second, chapter 11, which was originally the final chapter before the book expanded for its 5th edition. Now, these are both read by my audiobook guy, Joel, and some of you might be wondering, why have I not read these? It's not a lazy issue, but it's really tough to read books, especially this particular book, which is some 220,000 words. I don't want to estimate how long it would take me to read the Trend Following book. Maybe when I'm 90 or so and I'm near death, I will go back and I will reread all of my audiobooks in my voice. Maybe I will sound like a decrepit old man at that point in time and nobody will listen. Or maybe I will just keep doing what I'm doing and let Joel be the audiobook master, as long as he wants to keep doing my audiobooks because he's done a lot of them. Without any further delay from me, let's jump right into, hold on, there is a further delay from me. Back to School Special. If you would like to jump into my flagship training, limited time discount right now, email me, michael@covel.com. Now, without any further delay from me, let's jump right into 2 great chapters from my book, Trend Following. I guess this is another delay, but you might be thinking to yourself, how the hell can I call them great? Because damn it, I wrote them. It's my blood, sweat, and tears. It's not just bullshit. It's not just words. It means something. It means something to me, and it means something to my readers. Now, without any further delay, I hope you enjoyed these 2 chapters from my book, Trend Following. And again, that summer special, it's on. Enjoy.
Preface. Men wanted for hazardous journey, small wages, bitter cold, long months of complete darkness, constant danger, safe return doubtful, honor and recognition in case of success. Want to take the financial journey to a new investing philosophy that might very well affect the rest of your money-making life? I can't guarantee the yellow brick road, but I can promise the red pill will leave you wide awake. In late 2016, the Wall Street Journal reported that Steve Edmondson, the investment chief for the Nevada Public Employees Retirement System, has no coworkers, rarely takes meetings, and eats leftovers at his desk. His daily trading strategy? Do as little as possible, usually nothing. The Nevada system's $35 billion in stocks and bonds are all in low-cost funds that mimic indexes. He may make one change to the portfolio a year. Not exactly a life-changing revelation, I know, but that do-nothing, sit-on-your-hands investing premise doesn't stop with one-man shows. Dimensional Fund Advisors LP, DFA, the 6th largest mutual fund manager, is drawing in nearly $2 billion in net assets per month at a time when investors are fleeing other firms. DFA is built on the bedrock belief that active management practiced by traditional stock pickers is futile, if not an absurdity. DFA's founders are pioneers of index funds. Now we are getting somewhere, because just about everyone has money tied up in an index fund, which in 2017 is not exactly pioneering. But the much larger issue at hand, unknown to most, is that there is an academic theory that allows anyone to confidently index. The efficient market theory, EMT, states asset prices fully reflect all available information. This means it is impossible for average investors, or superstars for that matter, to beat the market consistently on a risk-adjusted basis, since market prices should only react to new information or changes in discount rates. EMT, set in motion with Louis Bachelier's PhD thesis published in 1900, and developed by University of Chicago professor Eugene Fama, argues stocks always trade at fair value, making it impossible for investors to either purchase undervalued stocks or sell stocks for inflated prices. Let me drop the nuclear warhead on that perspective. There is a mind-numbingly large hole in this cool-sounding theory. EMT, by definition, leaves the epic October 2008 stock market meltdown out of the academic equation. And for those who know about the sausage-making of writing peer-review papers or engineering a PhD, much of modern finance's foundation was bricked together with EMT mortar. Fama was ultimately awarded the 2013 Nobel Prize in Economic Sciences because his findings changed market practice, that is, the worldwide acceptance of index funds. Those findings are the generally accepted status quo. Not everyone, however, is a true believer guzzling the Kool-Aid. One of the first and loudest critics of EMT was famed mathematician Benoit Mandelbrot. He saw EMT proponents sweep big events like 2008 under the carpet, like kids house cleaning for the first time, calling them acts of God. French physicist Jean-Philippe Bouchot sees EMT marketing in play. The efficient market hypothesis is not only intellectually enticing, but also very reassuring for individual investors who can buy stock shares without risking being outsmarted by more savvy investors. Bouchot continues, classical economics is built on very strong assumptions that quickly become axioms: the rationality of economic agents, the invisible hand and market efficiency, etc. An economist once told me, to my bewilderment, these concepts are so strong that they supersede any empirical observation. As Robert Nelson argued in his book, Economics as Religion, the marketplace has been deified. In reality, markets are not efficient. Humans tend to be overfocused in the short term and blind in the long term, and errors get amplified through social pressure and herding, ultimately leading to collective irrationality, panic, and crashes. Free markets are wild markets. David Harding, a man you might not know yet, ratchets up the polemic by describing EMT in apocalyptic terms. Imagine if the economy as we know it was built on a myth. Imagine if that myth was the foundation stone on which the mainstream financial systems that control the global economy have been erected. The great bazaars of stock markets, bond markets, fiendishly complex financial instruments, credit default swaps, futures and options on which the fortunes of billions rest. Imagine if the myth was the key cause of the global crash in 2008, and if its perpetuation today threatened another catastrophic crash in the future. We don't have to imagine. The myth is efficient market theory, EMT. Harding does not have a Nobel Prize, but he does have a net worth of $1.4 billion. He is a flat-out financial heretic and would not be offended if you called him a punk rocker for his anti-establishment attitude. In prior centuries, he absolutely would have been burned at the stake for his wholesale dressing down of the financial high priests. He knows to question EMT is seen as madness by academics, banks, pension funds, and endowments. Interestingly, with a bipolar flair, the Nobel Committee split the 2013 Nobel Prize among economists with radically different theories. Robert Shiller, a man focused more on behavior and who shares the Nobel Prize with Fama, sees the contradictions. I think that maybe he has a cognitive dissonance. His research shows that markets are not efficient. So what do you do if you are living in the University of Chicago? It's like being a Catholic priest and then discovering that God doesn't exist, or something you can't deal with, so you've got to somehow rationalize it. Harding goes further, explaining EMT madness in an everyman way. This theory of rational markets treats economics like a physical science, like Newtonian physics, when in fact it is a human or social science. Human beings are prone to unpredictable behavior, to overreaction or slumbering inaction, to mania and panic. The markets that reflect this behavior do not assume some suprahuman wisdom. They can and sometimes do reflect that volatility. Further translation: human nature isn't rational. It blows bubbles and then pops bubbles. You can see this going back hundreds of years. Dutch tulip mania, 1634 to 1637. The South Sea bubble, 1716 to 1720. The Mississippi bubble, 1716 to 1720. The British Railway mania bubble, 1840s. The Panic of 1857. The Florida real estate bubble of the 1920s. The stock market crash of 1929. The 1973 to 1974 stock market crash. Black Monday. The stock market crash of 1987. Japan's bubble economy and crash, 1989 to current. Dot-com bubble, 1999 to 2002. United States bear market, 2007 to 2009. Flash crash, 2010. Chinese stock market crash, 2015 to 2016. Brexit, 2016. And on and on. But it's beyond not rational. Those events, the human actions driving those booms and busts, are best described by academia's prospect theory, cognitive dissonance, the bandwagon effect, loss aversion, and assorted heuristics in judgment and decision-making, to name a few of the hundreds of biases inherent in people's lizard brains. No doubt, the efficient versus not efficient debate will not be resolved in these pages. Perhaps it will never be satisfactorily resolved in an academic mine is bigger than yours sense, which would not be surprising given that human beings and their egos, greed, fear, and money are knotted up so tight as to restrict brain blood flow. And please, don't expect this work to be filled with the latest and greatest macroeconomic bubblegum predictions. You already know that is bullshit completely unrelated to making money, even if you have not yet admitted that fact to yourself. In the face of such chaos, complexity, and human frailty, my curiosity is quite simple. Answer a question. Why does David Harding think he is right? And, more importantly, how in the hell did he get all that money trading the likes of Apple, Tesla, gold, US dollars, crude oil, NASDAQ, natural gas, lean hogs, palm oil, wheat, and coffee, without investing in an index or having a fundamental expertise in any of those markets or the ability to predict directions? That is a worthy question, and the answer is a follow-the-big-money adventure. Trend following. The 233,092 words in this book are the result of my near 20-year hazardous journey for the truth about this trading called trend following. To this day, it still fills a void in a marketplace inundated with books about value investing, index investing, and fundamental analysis, but lacking few resources to explain how David Harding made his billion-dollar fortune with trend following. Out of the gate, let me break down the term trend following into its components. The first part is trend. Every trader needs a trend to make money. If you think about it, no matter what the technique, if there is not a trend after you buy, then you will not be able to sell at higher prices. Following is the next part of the term. We use this word because trend followers always wait for the trend to shift first, then follow it. Every good trend-following method should automatically limit the loss in any position, long or short, without limiting the gain. Whenever a trend, once established, reverses quickly, there is always a point, not far above or below the extreme reached prior to the reversal, at which evidence of a trend in the opposite direction is given. At that point, any position held in the direction of the original trend should be reversed, or at least closed out, at a limited loss. Profits are not limited, because whenever a trend, once established, continues in a sustained fashion without giving any evidence of trend reversal, the trend-following principle requires a market position be maintained as long as the trend continues. A big reason this conceptually works is seen in the wonky-sounding Bayesian statistics. Named for Thomas Bayes, 1701 to 1761, the belief is the true state of the world is best expressed in probabilities that continually update as new unbiased information appears, like a price trend that keeps updating and extending. New data stays connected to prior data, Think of a chain gang together. Random dice rolls, this is not. Trend following thus aims to capture the majority of a connected market trend up or down for outsized profit. It is designed for potential gains in all major asset classes: stocks, bonds, metals, currencies, and hundreds of other commodities. However straightforward the basics of trend following, it is a style of trading widely misunderstood by both average and pro investors, if it is known at all. Academic literature and real-world investors, for example, have put forth a host of strategies that on the surface appear unique, but at a high level they are all related to trend following. That classic trend wisdom has long failed to be understood in academic circles, that is, until very recently. Notable voices in the academic community have come around to agree momentum exists, the source of trend-following profit, but to confuse matters, they describe two forms of momentum: time series momentum, that is, trend following, and cross-sectional momentum, that is, relative strength. I don't see a connection between the two, and I can guess carving out business and academic niches for assorted reasons is in play, but I do know which strategy has produced decades of real performance proof, and it's trend following. The desire to enlighten this state of confusion is what launched my original research and ignited my passion, going all the way back to 1994. My plan was to be as objective as possible, pulling research data from wide sources. Month-by-month trend-following performance histories, hundreds of interviews conducted with subjects from top traders to Nobel Prize winners, published interviews from dozens of trend followers over the last 50 years, details not found on Google, charts of winning markets traded by trend followers, charts of historical markets seen across financial disasters. If I could have utilized only data, numbers, charts, and graphs showing extreme trend-following performance data, that would have been perfect. That is, after all, the raw, unassailable data. Yet without a narrative explanation, few readers would appreciate the ramifications of data mining. Robert Shiller has said that there is a narrative basis for much of the human thought process, that the human mind can store facts around narratives, stories with a beginning and an end that have an emotional resonance. You can still memorize numbers, but you need stories. For example, the financial markets generate tons of numbers, dividends, prices, etc., but they don't mean anything to us. We either need a story or a theory, but stories come first. Foundationally, my approach to researching and writing trend following became similar to the one described in the book Good to Great, in which researchers generated questions, accumulated data in an open-ended search for answers, and then debated it all, looking for stories, then for explanations that could lead to theories. However, unlike Good to Great, which was all about well-known public companies, to this day the strategy of trend following is still built around an underground network of relatively unknown traders who, except for the occasional misguided article, the mainstream press virtually ignores. And that has not changed in my 20 years. What I attempted with my first edition of Trend Following, and with this newest edition, is to lift the veil on this enormously successful strategy, how trend followers trade, and what can be learned that anyone can apply to their portfolio for profit. Throughout this effort, I avoided institutionalized knowledge as defined by Wall Street banks, brokers, and typical long-only hedge funds. I did not start with J.P. Morgan Chase or Goldman Sachs. Instead, I asked questions across all types of sources and then, objectively, doggedly, and very slowly, and even through some deep-throat help, answers that made intuitive sense were revealed. If there was one factor that motivated me to work in this manner, it was childlike curiosity, where you rip the toy open to find the motor and locate the essence. For example, one of my earliest curiosities was about who profited when a famed British bank collapsed, making the front cover of Time magazine. My research alone unearthed a connection between this bank and a wildly successful trend follower now worth billions. This trader's trend-following track record had me wondering, how did he discover trend following in the first place? I also wanted to know who won when a $2 billion hedge fund collapsed and almost sank the entire global economy? Why did the biggest banks on Wall Street, the so-called smart guys in charge of your retirement, invest $100 billion in this fund when there was so much obvious risk? Further, when I contrasted typical Wall Street losses during October 2008 to what trend following made during the same time in the great zero-sum game, it was hard to grasp why few market players were aware of the strategy. Other questions appeared. How does trend following win in the zero-sum game of trading? Why has it been the most profitable style of trading? What is the philosophical framework of trend following success? What are the timeless principles? What is the trend following view of human behavior? Why is it enduring? Many trend followers are still reclusive and extremely low-key. One who has beaten the markets for over 40 years works out of a quiet office in a Florida coastal town. For Wall Street, this approach is tantamount to sacrilege. It goes against all the customs, rituals, trappings, and myths embedded in so-called success. It is my hope that my narratives, backed by data, will correct misconceptions of winning as a harried, intense workaholic posted 24/7 in front of 12 monitors while downing Red Bull. One of my sources who helped break apart this puzzle was Charles Faulkner. He observed elite traders are almost floating above the world, seeing it from a different perspective than the rest of other market participants. His insights go straight to the core. It doesn't matter what you think, it's what the market does that matters. What matters can be measured, so keep refining your measurements. You don't need to know when something will happen to know that it will happen. Successful trading is a probabilistic business, so plan accordingly. There is an edge to be gained in every aspect of your trading system. Everyone is fallible, even you, so your system must take this into account. Trading means losing as well as winning, something you must live with for success. To adequately explain the genesis of this new edition, I need time travel. You see, my public trend-following persona started in October 1996 with a launch of a simple 4-page website. Armed with a political science degree from George Mason University, no connection to Wall Street or any fund, and with zero academic respect or PhD credentials, it seemed perfectly appropriate to create the first trend-following website. And I did. Loaded with original content, that rudimentary-looking site, turtletrader.com, generated millions of views, millions of dollars, and, unbeknownst to me at the time, respect among legions of beginner and professional traders alike. 6 years into that website, I decided it was time for a book, or maybe the book decided it was time for me. Larry Harris, the finance chair at the University of Southern California, randomly emailed me. He wanted me to review his new book because I was driving more interest in his white paper, The Winners and Losers of the Zero-Sum Game, than anyone else. Without skipping a beat, I said sure to a review of his book, but asked for an introduction to his publisher, since I was writing a book too. He obliged and connected me, even though my book at that moment was conceptual. After 2 years of starts and stops, Trend Following was finally ready. And when the first edition hit the streets in April 2004, I had no idea whether it would sell 10 or 10,000 copies. But immediately the book made an under-the-radar splash, landing in Amazon's top 100 of all books. In fact, that first edition was so expected to fail by my first publisher, you could only get it online. Initially, no bookstore. It went on to sell over 100,000 copies, with translations into German, Korean, Japanese, Chinese, Arabic, French, Portuguese, Russian, Thai, and Turkish. Its success led to 4 more books and the opportunity to direct a documentary film over the course of 2007 to 2009. I never expected an obscure trading book, first written 13 years ago, would lead me to conversations with 5 Nobel Prize winners or face-to-face learnings from trading legends Boone Pickens, David Harding, Ed Seykota, and literally hundreds more. This journey also led me to the world's top behavioral economists and psychologists, from Daniel Kahneman and Robert Cialdini to Steven Pinker. and it opened the door to my podcast, which has run since 2012 and now has over 5 million listens. My podcast has further featured guests ranging from Tim Ferriss to paleontologist Jack Horner of Jurassic Park fame, all connected philosophically to trend-following thinking, at least in my mind. Yet this wild ride has been far more than one-on-one conversations. The serendipity of trend following has led me around the world before live audiences in Chicago, New York City, Beijing, Hong Kong, Kuala Lumpur, Macau, Shanghai, Singapore, Tokyo, Paris, Vienna, and Sao Paulo. A speaking gig in front of 1,500 native German speakers at the Hofburg Palace, the former Imperial Palace in Vienna, Austria. That happened. And it kept going. Audiences with China Asset Management to Singapore's Sovereign Wealth Fund, GIC, to regular investor audiences with well over 1,000 people. Everyone from new investor to pro who wanted to learn more about trend following all allowed me to come into their world. But I recall my first public presentation in support of trend following, fall 2004 at Legg Mason's headquarters in Baltimore, where their chief market strategist had invited me to lunch. Afterward, I was escorted up a flight of stairs to a nondescript door. Upon entering the room, I found it filled with young bankers listening to a speaker. Michael Mobison, then Legg Mason's chief investment strategist, motioned for me to sit. I instantly recognized the speaker as Bill Miller, then the fund manager of Legg Mason Value Trust. At the time, Miller had beaten the S&P 500 index for 14 straight years and was easily one of Wall Street's most successful and famed players. Miller then introduced me to the audience. Until that moment, I had no idea I was up next. For the next hour, Miller from one side of the room and Mobison from the other side alternately peppered me with questions about trend following, risk management, and the turtle traders. After the presentation, I thanked Miller for the opportunity to make my case, but wanted to know how he learned about trend following. He said, "I surf Amazon for all types of books. I came across yours, bought it, liked it, and told all my people at Legg Mason they should read it." At that moment, I knew trend following might be catching on a little, at least in some very rarefied circles. Forget sales, which were very good. I knew that if trend following's message had struck a chord with Miller, who was not trading as a trend follower, I might be onto something life-changing. However, it is time to bring this living work forward to 2017 and a whole new audience and generation, for I have barely dented the broad consciousness of global investors. Roughly $80 trillion of investable assets sit squarely at the mercy of EMT inside buy and hold and/or passive index funds, with only 0.25% of assets in trend-following strategies. Almost everyone's savings and retirement monies are literally a slave to wobbly economic theory that leaves the masses unprepared for the next smackdown. That slavery is why I have yet again opened up the chest cavity on trend following. Not outpatient surgery to correct typos, but open heart surgery to add thousands of details. Big picture to minutia that bulk up the original to a new and improved Schwarzenegger on steroids edition. For starters, trend following is now divided into 3 sections. 1. Trend following's original chapters and principles, updated and extended. 2. Trend following interviews, new. 7 interviews from pros illuminate trend following's big picture with the requisite finer details. 3. Trend following research, new. Research contributions that add to the trend following conversation for average investors, professionals, and scholars. This is my most radical and extended volume. Content changes and additions are everywhere. It's now 3 books in 1. I have added material in a way where you can take small steps or go for the deep dive, starting on almost any page. The tone is different too. Toned down in some areas, toned up in others. Some of my younger blank and vinegar was expunged and reformulated to a new mature version, while staying true to the heart and soul of my origins. Last, some might complain that there is too much information, too much content, and I am throwing the kitchen sink at the subject. If so, I will be happy with that criticism. Guilty as charged. Now, if you're looking for guru secrets or easy money riches, please head on back to that OxyContin bender. There is no such thing. If you're in the mood for outlandish predictions, stories about the ultimate gut trader, or what it's like to work inside a Wall Street bank, or if you want to complain life is unfair and beg for the government to save you with a bailout, no one can help you on your path to irrelevance. Or worse yet, if you maintain faith in EMT, steadfastly refusing to consider overwhelming contradictory evidence, maybe you can burn me in effigy along with Bouchot and Harding. If you fit any of these problematic profiles, there's a good chance my words and my politically incorrect perspective will give you an aneurysm. Turn me off now. In the alternative, if you want outside of the box different, the truth of how outsized returns are made without any fundamental predictions or forecasts, this is it. And if you want the honest, data-driven proof, I expect my digging will give everyone the necessary confidence to break their comfort addiction to the box they already know and go take a swing at making a fortune in bull, bear, and black swan markets. Michael W. Covel. Chapter 11. The Game. Treat your life like a game. Ray Dalio. Trends come and go. Trend followers do too. Some stay longer than others. Ed Seykota. In Absolute Returns, author Alexander Anikin stresses that trading is nothing more than a game. There are three types of players in this game: those who know they are in the game, those who don't know they are in the game, those who don't know they are in the game and have become the game. If, within a half an hour of playing whatever game, and you don't know who the patsy is, you're the patsy or the game. Throughout, I've introduced traders who didn't know they were in the game and became the game in the big events of long-term capital management, the Barings Bank collapse, the October 2008 market crash, and Brexit. I have introduced traders and investors who did not know they were in the game and who pursued holy grails that never panned out. And I introduced trend-following traders who knew they were in the game and brought an edge to the table every time they played. If you know it's a game, and you must know that by now, the choices are stark. Acceptance. If you're concerned this work will create a new generation of trend-following traders, and that impact in the markets will negatively affect the frequency, direction, and intensity of trends, as well as an ability for everyone to make money, take note of timeless wisdom from trend follower Keith Campbell. We are trend followers, not trend generators. At the beginning or end of a major trend, we may provide a little bump or a minor goose, but it will be an extremely superficial, temporary effect. He is 100% spot on. Recall Larry Harris in Chapter 3. Traders play the zero-sum game for numerous reasons. Not all play to win. However, trend following is about playing the zero-sum game to win. And let's face it, that attitude will cause feelings of intimidation, defensiveness, and jealousy. At the end of the day, for trend-following trading to lose its effectiveness, dramatic changes must unfold. No more passive buy and hold. Those believing in fundamental analysis, vast majority of market participants, would have to switch how they invest. Will they cease buy and hope, long-only index approaches, and start trend following? Never. Globally, there are $80 trillion of investable assets, and only $200 billion are in trend-following strategies. 0.25% in trend following means no way. Start trading both long and short. Most will not sell short due to fear, ignorance, or confusion. They trade long only. That changes when index and mutual funds cease. This is hard to do with retirement programs mandating legally that average Joe be 100% invested in certain instruments, while legally being precluded from other opportunities. Embrace money management. Most don't know how much to buy or how much to sell. They only worry about when to buy, rarely thinking about when to sell. Recklessly bet 50% on one opportunity alone that could have the odds of a coin flip? People do it all the time. Need even more proof? Las Vegas and Macau, China. Go see both firsthand. Disprove Daniel Kahneman and Amos Tversky's work. As long as there are human beings trading on markets, and regardless if robots are involved or not, chaos will reign supreme. You want to fixate on robots and code as a game-changing excuse? Hold on. Let me ask, who do you think programs the robots? People write the algorithms that make the robots execute. There will always be excessive reactions up and down with trends to exploit for the systematically inclined. End career risk. Author Jason Zweig. You might think a fund manager's job is to beat the market, but in fact, a fund manager's job is to keep his job. That conflict kills trend-following acceptance on Wall Street. What? This trend-following stuff doesn't spin off massive commissions for me? No, Mr. Jones, you don't want that. Let me tell you about some news circulating around this great biotech virtual reality porn penny stock. People love the fantasy. Trust but verify. Too many don't have an understanding about process. They trust guys wearing $5,000 suits, no questions asked. They judge trading outcomes with zero understanding of the skill-luck interplay. Wealth alone is not wisdom. Never forget that. Central banking interventions go away. Seizing control of your financial future is a must, especially in a world filled with crazed bankers hell-bent on taking what you have left. The pressing fear? At the next bubble pop, the system won't be able to raise asset prices again because the bullets will have left the chamber. At that moment, everyone will officially be Japan. No more stock market wealth effect to trick investors into believing they are rich. The jig will be up. But the real problem isn't that central bankers are out of ammunition. The problem is they have the patient tied to the operating table with zero anesthesia, performing Civil War-era surgery, knowing full well the odds for survival with a hacksaw are brutal. Never, ever underestimate how crazy things can get. When does central bank funds stop? It doesn't. Stop asking why. Too many demand narratives for market moves. They must know why. Trend following doesn't need to know why. Let's be candid. Most are more comfortable with the status quo, even if that means losing their life savings when the next black swan swims in. And at least then, if the neighbors lose it all too, they can be happy in misery together. Accepting that all of their market knowledge is faulty would predictably trigger in investors a mega release of the stress hormone cortisol. Millions would rather zone out on Netflix, bicker on Facebook, post on Instagram, send troll tweets, farm digital crops, or pretend the next president will solve it all, than learn how to trade correctly for the chance at the life-changing gain. Don't blame me. It's not surprising that trend following is sometimes accused of throwing markets into disarray. Whenever a stock tanks, a bubble bursts, or scandal hits, winning traders catch the blame 9 times out of 10. The blame is never affixed to the little old lady in Omaha who lost her life savings gambling on biotech penny stocks. The blame is never placed on the masses that were gambling the Dow would go up forever, only to see it crater 50%. Few take responsibility for losses, and who better to target when the mob is feeling panicky than rich winners? Here are my favorite misconceptions that make trend-following devil incarnate evil. It trades futures, currencies, commodities, ETFs, etc. The vast majority of trend-following traders trade on regulated exchanges. We can all trade there. If we can all go there, why is trend following singled out? Politics. It uses leverage. Great traders use the tools at their disposal, one of which is leverage. The key is not to overdo leverage like so many on Wall Street do time and time again. It causes worldwide panics. Trend following does no such thing. It reacts to unexpected events. There is no crystal ball. It doesn't invest, it trades. The markets are for trading, not investing. The markets reward winners, not losers. We can all choose, and if we choose wrong, it's time to look in the mirror. Giving trend following flack for making money on the downside ignores the skill involved. Traders have always been an easy target for the press whenever the public is looking for someone to blame for volatile markets, and the press have singled out the short sellers. Making money in down markets is portrayed as obscene and to blame for additional turbulence. The industry is not about bad boys manipulating the market and gambling. It is about specific trading skills practiced by highly experienced traders who are rewarded on performance alone. The notion that producing money in down markets is obscene is in itself obscene. Markets have rules. You can go long or you can go short. Serious players trying to make FU money deal with the rules and don't make excuses. And if you don't know the rules, that's on you. Jerry Parker, however, believes trend following must do better at explaining the inherent skill set. Another mistake we made was defining ourselves as managed futures, industry term for trend following, where we immediately limit our universe. Is our expertise in that, or is our expertise in systematic trend following or model development? So maybe we trend follow with Chinese porcelain. Maybe we trend follow with gold and silver, or stock futures, or whatever the client needs. But a day will come when people will see that systematic trend following is one of the best ways to limit risk and create a portfolio that has some reasonable expectation of making money. In an unpredictable world, trend following is the best tool to manage risk and uncertainty while possibly producing outsized returns. The performance sets of David Harding, Martin Luke, Ken Tropin, Lita Braga, Ewan Kirk, Bill Dunn, Jean-Philippe Bouchot, Jerry Parker, Keith Campbell, George Crapple, and Larry Hite, to name a few over the past 40 years, are incontrovertible facts. Decrease leverage, decrease return. Richard Dennis's Turtle students, see my book Turtle Trader, were originally instructed to make as much money as possible. They had no restrictions except to shoot for home runs. They were absolute return traders while under Dennis's guidance. However, when they went out solo to trade for clients, there was style drift. Many accepted clients who demanded less leverage and ultimately less return. Dunn Capital knows to aim for and win big profits, trader and client must be synchronized. Dunn is adamant about alignment. Now there is, of course, the possibility of turning down the leverage and trading more capital, but with less leverage. That works fine if the client will go along with you and you're charging management fees because you are charging management fees on the capital and then incentive fees on the profit. We do not charge any management fees to any of its clients. We care about the numbers that are generated. Some might feel safer with watered-down trend following at a lower volume, lower reward, but the true way to the change-your-life money is through higher volume, higher reward. The key, regardless of leverage choice, is to be in concert, as trend trader Jason Russell prescribes. Managers often say they are managing to long-term objectives, but act to meet short-term objectives of clients who have not spent the time understanding what trend following means to them. As much as the managers, industry, and regulators try to educate and illustrate, the ultimate responsibility lies in the hands of the client. Bottom line, trend-following strategies stylistically vary due to volatility targets, leverage choices, speed, short or long-term trend targeting, and sector exposure, narrow or widely diversified. Trader Josh Hawes summed up the choices from another vantage. There is fund-level risk, account-level risk, trading system-level risk, and position-level risk. Let that sink in before you leap. Fortune favors the bold. It's more than the model, though. An associate drove home the point. Trend trading and even trading in general isn't for everyone, as too few people check out what the day-to-day life of a trader is like, and trend trading specifically, I strongly recommend they find out before making a life-changing commitment. Life-changing commitment means not needing to be right. Most must be right no matter what. They live to have others know they're right. They don't even want success. They don't want to win. They don't want money. They want to be absolutely right. The winners, on the other hand, they just want to win. That's not all. You commit to patience in a trading process not structured on quarterly performance measures. You work hard to gain experience, and great experience leads to discipline. You commit to the long term. A real strategy might have one year when you are down 10%. The following year, you might be down 15%. The next year, you might be up 115%. If you quit at the end of year 2, you never get to year 3. That's the reality of sound strategy, for life or trading. Larry Hite paints the picture of that risk choice. Life is nothing more than a series of bets, and bets are really nothing more than questions and their answers. There is no real difference between, should I take another hit on this blackjack hand, and should I get out of the way of that speeding and wildly careening bus? Each shares two universal truths, a set of probabilities of potential outcomes and the singular outcome that takes place. Every day we place hundreds, if not thousands of bets, large and small, some seemingly well considered, and others made without a second thought. The vast majority of the latter, life's little gambles made without any thought, might certainly be trivial. Should I tie my shoes seems to offer no big risk, nor any big reward, while others, such as the aforementioned speeding and wildly careening bus, would seem to have greater impact on our lives. However, if deciding not to tie your shoes that morning causes you to trip and fall down in the middle of the road when you finally decide to fold your hand and give that careening bus plenty of leeway, well then, in hindsight, the trivial has suddenly become paramount. With trend following, you commit to a big-time decision that's not trivial. Trade by yourself, seizing opportunity, or let a trend-following pro do it for you. There are pros and cons to both choices, but you won't know the best direction until you get in the game and stop with the passive buy and hope, long only, everything will all be all right, I trust the Fed implicitly, black swans are extinct insanity. For unlike the foundation of the efficient market theory, trend following's enduring principles are not grounded in intricate algorithms or kept inside theorems with obvious holes. Trend following principles are solid proof that typical strategy seen across Wall Street and Main Street is at best built on a clumsy error, or at worst, a slick lie. Note, this was the original ending for my first 4 editions, but for this 5th edition, I added extensive new interviews and research sections.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.